Thanks for joining us on What's Hot. Straight to the top story this evening. India's trade deficit has hit a 37-month high of $14.88 billion in December. Exports grew at over 12% to $27 billion. However, imports outpacing that growth, surging 21% to about $42 billion. What is most worrying about the trade numbers is on several parameters. Trade deficit, gold imports and crude imports, the numbers are looking eerily similar to the pre-taper tantrum days. Lata joins us now with more. So Lata, gold imports largely responsible for the kind of trade deficit we're seeing?
Well, a bit of it, partly responsible, but there have been other reasons as well. This $14.88 billion trade deficit is worrying. We did see one spike to $16 billion in November of 2014, but that looks like a freak because before and after we were at, 10 billion and 13 billion. We have never gone beyond that, but in the pre-taper tantrum days, we were averaging 14 to 17 billion. It is an unsustainable number for us monthly, unless we get $3 or $4 billion of FII or FDI inflows. We cannot sustain a trade deficit of 14 billion. We can manage up to 12 with 12 billion deficit. Beyond that, we are risking, we are at the mercy of foreign flows, portfolio flows. The second similarity, gold imports had fallen to about $1 billion, $2 billion in the years of 2014, 2015 per month. Now, for the last 3 months, they are averaging about 3 billion and more. This time it has come in at 3.4 billion. This means something like 73, 74 tons of gold being imported, and that will mean an annual run rate of 900 tons, exactly the number which was imported in the 2012 days. Again, very eerie. Crude, it's easy. Crude prices have risen, and of course, there is a pickup in industrialization, so that growth also by about 35%. $10 billion is a number we should be worried about. I just want to point out to one or two other worrying trends. For all the exports growing at 12%, ready-made garments are contracting by 8%. This is a employment-heavy industry. So are gems and jewelry. 2.4% at a time when gold imports are rising, doubling year on year, and even pearls and semi-precious stones are rising. But gems and jewelry not doing. Again, it's an employment-heavy industry. Man-made yarn, again, employment-heavy industry, not doing anything like other exports, just at 6%. Among imports, the worrying thing, of course, is gold and crude. But even electronics and pharma have shown some increasing imports, which is a bit worrying. But we have some experts on that, Shireen?
Yes, we do. Lata, Soumyakanti Ghosh of SBI and Aditi Nair, Principal Economist at ICRA, with us. Lata, hang in there as well. Soumya, let me come to you first. 37-month high, that's the picture as far as the trade deficit is concerned. Lata and I were just discussing the internals largely on account of gold as well as crude imports. Would you be concerned with this number, Soumya?
No, I hope that this number is a one-off number, but I would like to see that the export growth rate at 12% actually goes higher, because this month's number, apart from the gold imports, which Lata was pointing, is also a fact that it's also the crude imports. If you look into the oil imports, they have also soared, and that's basically the price impact. And there is another worrying factor which has been continuing for the last couple of months is the electronic imports. So I think this is some of the factors which are point of concern, and the contraction in apparel exports is actually a point of concern, because if you look into the US data, Office of Textile and Apparel of other countries, they are actually gaining in market share in the last couple of months. And since apparel exports is actually a price sensitive export, is mostly price sensitive, and losing the market share in apparel, it's a point of concern. So my hope is that the export growth picks up maybe beyond 12% so as to negate any adverse impact on the import growth. Otherwise, the numbers could look a little bit worry in the next 1 or 2 months.
Yeah, I take your point, Soumya. Aditi, our imports are showing a steep growth, largely because of commodity prices rising. Soumya pointed to crude. If you run through the list, then there is non-ferrous metal, steel, not so much steel, but more non-ferrous metals, chemicals, plastics, all of them, paper, all rising because the price of the commodity has gone up. But we don't seem to be participating in the global growth story as far as exports are concerned.
Absolutely. Absolutely, Lata. I think, just going back to what you guys have been saying on the import side, 80% of the increase in imports has come in from crude and gold, as you mentioned, but also the pearls and semi-precious stones. And on the crude side, definitely the price impact is there, but when we kind of back calculate and look at what has happened with volumes, the volume growth has spiked so much in December that I don't think that that's a sustainable trend which will continue over the next quarter. So at least on that point, I'm hopeful that even though prices are likely to stay elevated, we will not get this kind of volume growth coming in over the next quarter. On exports, the worry that I have is that we've seen a very broad-based slowdown in export growth. All of our major export-oriented sectors are showing a slowdown in growth in December compared to what was posted in November, and it's not just a one-off or one sector that's dragging it down, but it's very broad-based. Textiles, as you said, also gems and jewelry, a lot of the electronic and engineering goods sectors as well. So I think that's a worry. Seasonally, Q4 should be a smaller trade deficit. I think, we can pin some hope on a seasonal correction coming in, and gold imports, I certainly don't expect will continue at this pace in Q4.
Okay. Well, one hopes so, because it is third month in a row that we have got a gold import number of over $3 billion, which would be something like 72, 73 tons. That's a bit worrying. But Soumya, we need not worry too much, you think, because anyway, the dollar is on a weak mode. So tomorrow, maybe the rupee will depreciate, but not by a great deal. What's your sense on the impact on the exchange rate?
See, in terms of the, yes, you are correct in the sense that the dollar is, given the trends in dollar, but I am not so much hopeful of an rupee weakening very soon, because I think the interest rates are likely, the Indian contracts are likely to remain elevated. So from that point of view, I think the capital inflows will remain strong, and that will push up the exchange rate. My only point of worry is that we participate in the global growth story, because if you look into the data of the global exports and Indian exports, and if you plot them over the period 2004 to 2008, you will find that in the times of when the global exports were actually growing at around, say, maybe 10 to 20%, Indian exports were growing at 40%. So that's actually made the difference to the growth numbers in those days. So until and unless the export growth rate materially picks up, I think there will be some problem with the trade deficit.
Fair point. Well, we'll have to leave it at that. Soumya and Aditi, thank you very much for joining us. Shireen, for me, the worry is that this is not looking like self-correcting. If the rupee were to depreciate, then automatically imports get expensive and you would import less of certain things. But because of the weakness in the global dollar flows and the continued flows of some kind of, dollars or foreign flows, the rupee is not depreciating much. So there is no self-correcting mechanism. And a one-shot correction should not happen. That can be debilitating.
And the export story that we were talking about, Lata, and especially on the textile side, the ready-made garment, the apparel side, I think that is going to be a big cause for concern and worry. I mean, we're talking about creating jobs, and these are large employment-generating, labor-intensive sectors where India is losing global market share. So that's going to be a cause for concern. Lata, thanks very much for joining us.